Hey everybody, welcome back to the Teaching Tax Flow Podcast, episode 194. We are finally going to touch on a topic really I don't know anything about. So I am honestly just going to shut up for once. Chris, I know you're excited about this. Our guest is going to be
All
extremely
right.
excited about this because I have I have a marker, I have a pen, I have my notebook in front of me. I'm ready to start writing this stuff down. We are going to talk about Trump accounts. So totally, I guess, apolitical is probably the best way to put it. We are going to talk about how these affect people who they apply to. How do you go about them? Everything we know about them as of this date, we are going to dive into it. And our guest was actually on a news program not too long ago about this. So obviously we bring in the people that know a lot more than I do, naturally. But Chris, welcome back to your own show, sir. Give us a little kickoff here and tell us who's going to talk about this topic with us.
Well, I'm really excited about this episode. We've been wanting to tackle Trump accounts for a long time. We know that the OB3, One Big Beautiful Bill Act, was signed into law almost a year ago. In this year, 250th anniversary of our country, July 4th here, 2026. It's going to be marked with the kind of the birth, I wouldn't say birth, but the guidance of Trump accounts. And we talk about one of the three laws of teaching tax law being tax agencies are our involuntary business partner. Tax laws are written to encourage and discourage certain behavior. That could be economic, it could be social, it could be environmental. And this law is no different. The birth of Trump accounts. I'm super excited to have Andrew Wallner, CPA, join us. Andrew and I have known each other for quite a few years. He is a member of the Michigan Association of CPAs. I consider him a friend. Him and his wife have an amazing team and run an awesome practice almost to Canada, way up. If you are familiar with Michiganders, you know what a Youper is. And Andrew brings a wealth of knowledge. So we want to bring him in because John, you're right. He was just recently on some local news media there talking about Trump accounts. So Andrew, welcome to the Teaching Tax Flow Podcast.
Yeah, thanks for having me. I'm honored to be on the show here. Met Chris and John a while back at some seminars and really kind of appreciated their insight that they brought. And, getting to see folks like that inspires us to bring more of this information out to the public, and of course, as Chris mentioned, we are in the Upper Peninsula of Michigan, close to Canada. It'd be a really long swim across Lake Superior to get there, cold swim as well. But, our firm here has been here for quite a few years, since the 70s. My wife and I took over majority ownership a few years back, and we run about 20 employees strong, and big focus on tax planning. Obviously, preparation goes along with that. But these opportunities, and like later on the show, as we talk about these Trump accounts and the opportunities that are there for investment for children and tax deferred savings accounts, these are the things we'd like to bring to our clients to really add value to the tax preparation process, which I think is paramount for firms going forward, as you've mentioned in many of your seminars too.
Well, if you're watching on YouTube, which you should be, and if you are, definitely subscribe and like and share this. You'd see that Andrew's a young, strapping young man, and I bet he could swim across that Lake Superior, or at least he'd jump on a jet ski and try to rip through. I don't know if you'd have enough gas. But yeah, we are. So let's talk about these Trump accounts and Andrew, this is great because I know you've had some personal experience with these as CPAs, and you mentioned that your firm is forward focused, in my opinion, and does value tax planning and strategy. I think a lot of times taxpayers and tax professionals focus way too much on immediate tax deductions and immediate tax, quote unquote, savings. Sometimes, actually, it's not a saving. Sometimes it's a deferral. And a lot of times, there are opportunities to put money away, what we call our gold diagnosis, tax-free income and growth, into 529s or into Roth accounts. But those come with different rules where I feel like Trump accounts are, for lack of a better term, non-denominational. And the intention is to allow families from all different socioeconomic situations the ability to put money away and see some tax benefits. And can you again give us an idea of what you're seeing out there and what a Trump account is?
Yeah, so a Trump account is essentially a vehicle for children to have money put away for them, either by way of their parents putting it away or someone else that that would like to set that aside, grandparents, aunts, uncles, those sorts of things, putting it away while they're within a certain age, and that money can grow tax-free, what they're referring to as the growth period, which is all of the years that the child starts the account till they turn age 18. And then at that point, when they turn 18, that becomes the child's account. And at that point, it becomes a traditional IRA. So that was a big question mark with a lot of people. There was that a lot of information about it was going to be a Roth. It was going to be this. No, it becomes a traditional IRA. And then it has all of the elements that need to be considered for a child as a traditional IRA. But what I'm most excited about on this is when we're doing a lot of tax planning with clients at every income level. I mean, I don't care if you got $5,000 or you've got $5 million, you should be planning. And a lot of those conversations with people come into the idea of setting money aside for children. And if there's one thing I really don't like is having to file a tax return for a child. And a lot of those grandparents ask about putting money away in UTMAs and UGMAs. And although the intention is amazing, I just don't like kiddie tax. I think it's an unnecessary burden that people don't understand, and it's expensive to prepare tax returns. So I like these and I'm excited about them because now we can put some money aside for kids, and that money can grow tax-free, and it does not have to show up on the tax return. And the kids can't take the money out either. That's the other concern, is what if this money goes in and mom or dad or somebody wants to take this money out? You can't get to it till that becomes 18 and it becomes the child's account. And getting this out to everybody, the reason I want to talk about it is I just don't think enough people understand how you get these opened up, how you get them started, because it's not an automatic thing. And so you have to have a trusted advisor as a CPA or yourself with enough knowledge to get the amounts or get the items filed on the return. That way you can get these accounts set up either with the funding that the government will provide or some of the other programs that have popped up along with this. That form has to be filed first.
So I want to touch on something, and then we'll jump into that funding. What Andrew's talking about with the kiddie tax is, sometimes in our households we chuckle and say no good deed goes unpunished, right? So sometimes you have benevolent grandparents or uncles, and they put money away into a special type of account for a child, uniform trust or Uniform Gift to Minors Act or something like UTMA, in those type of accounts. And it's great because that money's earmarked for the child, but as that money grows and earns dividends and interest, that's all taxable. So you're paying an actual tax on that, and also typically at the parent's rate or a higher rate. And then there's another tax as far as compliance, meaning you have to pay to have those tax returns prepared. So you're taking a big chunk out of that growth, where with a Trump account, you don't have to file a return as long as the money's in there. As Andrew said, it's kind of like an IRA. I want to talk about distributions in a couple of minutes, but let's talk about funding it, because you're right, there are no income limits. And this is a fluid situation, right? That we're going to receive more guidance in the next few months, and then we'll up your name, image, and likeness contract to come back on the Teaching Tax Flow contract podcast. But to sort of fund it, that's done. I know that it could be done using when you have your tax return prepared or separately. But also, you mentioned something called a pilot program, where just like a 401k, the government's actually putting a match in there for the first X amount of people that form an account.
Right. So, namely, the first one that hit everybody with the discussion was if you are a child born January 1, 2025 through December 31 of 2028, so a brand new child, that child would qualify for the pilot program, which is a $1,000 deposit that would go into this account. To qualify for that, you just have to be born. That's the first thing. But to enroll for it, you must file a form 4547. The easiest way to do that form is with your CPA, preparation of your tax return. It just gets added onto the form and the child gets put on there. So for instance, this year we did quite a few of them as we were educating our clients to do it. Really easy form. You had to pick the person who was going to be in charge of it, put an email address on there because that's how a lot of the things are going to come through, and then put the child's information, date of birth, those sorts of things. That wasn't just for kids born this year, though. Any child under age 18 has to go on that tax form. And furthermore, if you have a new child in future years and you've enrolled once before with other kids, you would have to file a new form 4547 each year you have a new child. If you enroll and you're not born in those times, there was these other programs that popped up though, like what's called the Dell contribution. And so the Dell family put some money aside, and I think the number is like the first 25 million children or something that enrolled, they would potentially qualify for $250. So if you were born before January 1 of 25 and under age 10, you could potentially get $250, even though you don't get the 1,000 pilot program. But you had to live in a zip code where the average annual income is less than $150,000. So there, again, there's all these rules, regulations that you really got to lean on your CPA to get you through these things. And then how is that going to get funded? If I'm being completely honest, we have no idea. It's a branding program, but the enrollment has a process that steps through. You'll get an email that will invite you to set this up. And then like myself, you download an app, which I've done, and I got my email. As soon as I got the app, I got the email, you enroll, and then your children pop up on there. There's big fancy pictures that say, get ready. We're going to fund this thing in the fourth if you want to do it. But how does that 250 show up? How does the 1,000? That's going to be related to Treasury. So it's really going to be on them to have that money go in there.
So just so it's that form 4547 is
Correct.
how you that could be filed with a tax return. But if someone's watching or listening and they said, darn it, my tax return's been prepared, they can go on and file that right through, through the IRS website. Or they can find that form on the IRS
Yeah, so
website.
a couple of avenues on that is that if you download the 4547, you can mail it in, I believe fax as well. You'll have to follow the instructions that go along with the form. That's obviously going to be your slowest method because somebody's going to have to handle it. They're going to have to process it. And you're mailing a lot of information with social security numbers and such in the mail, which has its own risks. Or you can go to the only website you should visit regarding the Trump accounts. I think there's going to be some bad actors out here. So I also want to caution people, pay attention to the URLs, pay attention to what they're asking you for. But trumpaccounts.gov is the only website people should be looking for information on this. And it steps you through a lot of great information on there. Also, if you've been wise enough to set up an IRS e-services account, you can also track the progress of your Trump account enrollment on that website through your IRS account. So again, another really important reason for every taxpayer to set up an IRS account as well. And of course, you have to have a husband and a wife that set up their own accounts individually, but you can follow it and file the forms all through those things that you mentioned on the IRS website.
Wow. I mean, this is nice because it's free money, it's free income and growth. Let's talk. We're talking about funding. I know there are limits every year for funding it. I want to say it's like $5,000, or there's
Correct.
Which is great. The nice thing about, I want to move over to this compared to a 529, meaning this type of account gives you more opportunity to take the money out tax-free, right? Yep. Down the road. So I've called and maybe this wasn't the best term, but I called it the Frankenstein account only because it's kind of like an HSA in some ways, works kind of like a Roth in some ways, a traditional and a 529. So you don't get a tax deduction when you fund it, but that's okay. The money grows tax deferred and tax-free if you take it out as a qualified distribution. And unlike a 529 plan, there are a lot of different types of qualified distributions someone could have. Is that
right? So correct? One carve out in there that you mentioned about the tax-free, you don't get a deduction going in. There's a potential free deduction. I know we're going to get in the weeds a little bit on this, but some people should be aware that they may start hearing about this from their employers because there is a carve out through the cafeteria plans or Section 125 plans that if your employer allows this, you could actually defer out of your paycheck up to $2,500 a year, which means you're saving federal, state, Social Security, Medicare, all those things. So it could go in pre-tax, and then the employer could fund that into your Trump account. Now, if you're under 18, you don't get to fund your own Trump account using a cafeteria plan. But I don't know how many 18-year-olds are worried about tax deductions at that time. So there is one carve out that you can get that money in tax-free. And I think some employers might start to jump on that once it becomes more information available. But then, of course, back to the distribution standpoint, like you said, the money goes in up to $5,000 a year in total. All contributions can go into these plans. So if the government gives you $1,000, and you decide to do a piece with the employer, you're up to $3,500, you could fund $1,500 more of your own money out there, but it can only be $5,000 per account per year. And the $2,500 is per employee per year.
Right. And let's say a child's 18 now down the road. I know, you've taken advantage of Trump accounts as well. And let's say they have $30,000 in their Trump account. They can utilize that tax-free. They can take tax-free distributions if they take money for a qualified distribution.
Well,
what do we think is going to be a qualified distribution?
Well, so potentially out of there, it will become a traditional IRA. So there will be tax considered in there, right? So those are the things that once you get to that point, a distribution will be taxable out of there because it will become a traditional IRA. I've not gotten into the weeds to see if there's some carve outs with the Trump accounts. If you've seen something, again, information is coming brand new to this as we go. My understanding is that all of these distributions later on down the road will have some taxable items in there, but it opens up a lot of things for these kids that if you funded it to the fullest extent and that child's got a bucket of money, the child could take it out to buy their first home. They could claim, no penalty on it. They could do a Roth conversion. If they're in a low tax bracket and it makes sense to do tax planning with them, they could do a Roth conversion if you're steering that child through there. They could take it out like a 529, like you mentioned, for educational purposes. Of course, it will be taxable. It will not have penalties so long as it's used for education purposes. But again, if the child's not working that much, it's a pretty low tax bracket. But, again, we get into IRA distributions. You got to consider a little bit of kiddie tax concerns on that too. But again.
This podcast is sponsored by Reps Tracker. Are you a real estate investor who is bogged down with the huge tax burden? Real estate investing can open the door to powerful tax benefits. Reps Tracker can streamline the process of accelerating these opportunities. To take advantage of a special TTF community discount, go to teachingtaxflow.com/reps, REPS, and use the code IFG. Better yet, click on the link below in this episode's show notes to go directly to the Reps Tracker sign-up page.
But if a child takes it out for education at age 19, you've got to assume that their marginal tax rate, if they're in college, is almost nothing. I mean, it's going to be small.
Yeah,
much less than
one
the
would think,
parents.
right? And if you take out enough and that provided more than half of their own support, could they claim themselves as a dependent and then get the education credit and not pay any income taxes because the parents don't get an education credit? So again, I'm like frothing at the mouth how cool these opportunities are going to be down the road.
Definitely an opportunity. And one of the things we talked about before we recorded was I like that this gives an opportunity for families that really didn't have exposure to investments. Like, I didn't know what a mutual fund was or a stock was or anything until I really got into the quote unquote into my early 20s and in my first 401k. So I think that the opportunity for any type of household, no matter what your situation is, this has an opportunity to take advantage of this. It's not income dependent. It's not phased out. It's really and it's kind of cool that once these accounts are set up, I think for kids to watch them and maybe see them grow a little bit too.
Right. And again, at our firm at Tailored CPAs, we believe in planning at all income levels. And we get so many questions about these investments that this is a great vehicle to teach a young child at a young age what stocks are, how these mutual funds work, those sorts of things. And what is neat about these programs is that you're going to have to lean on a tax advisor to help you get these forms filled out if you're not comfortable with it. But then these are going to sit in the background in low cost ETFs. So you're not going to have a big chunk of fee going out as the investments are rolling. So it's got a better opportunity. Now, it looks like the app is showing that they're going to partner with Robinhood. That's one of the names on the app at this point in time. So what that mechanism will be, monthly statements to monitor, I don't really know. I'd have to assume it's going to be invested in like a target fund where like the child is 0 now. At 18, maybe it scales the investments in whatever it does. But again, the child is going to learn compounding interest. And I think that is phenomenal for anybody to teach their children how money works and how it can really incentivize their long-term lifetime goals.
Well, Andrew, we can't thank you enough. This has been great. I've learned things. I know John's learned some things. Our community is going to be thankful. And once we get some more clarity, I think it's going to come through in the summer. I'll be seeing you in about a month anyway. Maybe John and I will buy you a beer and convince you to come back on the show.
Yeah, July 4th. These are apparently open for funding, and interesting. I don't think there's any banks open that day, but I guess after the parade, you can go in and open your app and get the money moving. So thank you guys so much for having me.
There you go. And absolutely, man. It was good seeing you again. Good chatting. And as everybody who hopefully you chimed at the beginning of this, I actually held my promise and I shut up the entire episode. So my wife would be happy because she says it never happens, but it did. And Andrew, I want to say one thing or reiterate one thing that you said that I think was super important. I don't know if you even realized that you said this. You talked about how that example you talked about the education credit, et cetera, and kind of showed it audibly showed how all these things could turn into something else. But you ended with, I don't know if you said it verbatim, but that really is tax planning as a whole. So this is super important. And I love that. I wouldn't call it forced financial education with people, but it is a little bit, which I think a lot of people lack, right? It kind of maybe pushes things to the side of saying, oh, I wish I would have done something earlier. Well, here's a chance possibly for a lot of people. So I look forward to it. I'm glad that we edit these podcasts in-house because now I have to go back and listen to this thing a couple times and actually then I'll take my notes. So I appreciate it, man. And as Chris mentioned, we're definitely going to have you back because obviously we got new news being released on these. So it'll be there. We'll be here. We're going to convince you to come back and join us too, man. So we appreciate it.
Yeah, look forward to it.
Awesome, gentlemen. Well, thank you for hosting this podcast without me. So this was great. You didn't need me. And anybody who's listening, watching this again, make sure you subscribe to the YouTube channel. You'll get all those notifications as well. Specifically on this topic, you can actually search on this channel to put in Trump accounts here in a month or a couple weeks. And as we release new stuff too, you'll get it straight from the channel. So check it out, everybody. And you have a great, great week here as we venture into that. Was it 250 years of the existence here? Legal existence, we'll say, of the U.S. And have a great week. We'll see everybody back here again next week on the Teaching Tax Flow podcast. See everybody soon.
The information in this podcast is educational and general in nature. It reflects the opinions of Teaching Tax Flow and does not take into consideration the viewer's personal circumstances. It is not intended to be a substitute for individualized financial, legal, or tax advice. Consult the appropriate qualified professional prior to making any decisions. Securities are offered and supervised through Cabin Securities Inc. member, FINRA, SIPC. Investment advisory services are offered and supervised through Cabin Advisors LLC, an SEC registered investment advisor. Chris Picciurro is a registered representative of Cabin Securities and an investment advisor representative with Cabin Advisors LLC. Teaching Tax Flow is an independent entity and is not affiliated with Cabin Securities or Cabin Advisors.